What's up, everybody? Welcome back to Sales Remastered. It's been a while since I actually released some updated content and I feel like it's overdue. So the topic in this particular video is going to be about the market and why some LOs have a challenge in actually surviving market shifts or when market changes. And as you and I know, the market in itself, like rates and pricing, they're cyclical, meaning that there are times where the market goes up, and then again, there are times where it goes down. And it's very applicable to the days as of late because we're coming from a pandemic where the rates dropped to an all-time low. I've never seen interest rates drop that low. And now we're at a rate that's 3 times what it was just a year and a half ago or in the last couple of years. And what I do know is, a pandemic is probably the only thing that will actually put a market rate that low. The second thing I know is that because of where the rates are, the next market boom or refinance boom that we'll see may not necessarily drop it down to the 2s, but instead it's going to be lower than what they are today. So average loan rates is what, 5.5%, 6%, and that's with points. Do you remember when we were giving out loans at like 2.5 and that was so much rebate where it covered the lender fee, or 2.75 and it had no fees? Well, now it's opposite, right? So it's definitely, understandable that you're going to have a challenge when the rates go not only, more than twice what they were, but now you're actually charging points on top of closing costs. And so we're kind of hit with like a two-edged sword here. And why I wanted to share this video is because I, for one, as you already know, I'm an originator just like you. And I personally have been doing this for over 20 years. That's what the gray hair is for. And I've been through a couple cycles in my time. And so what I want to do is I want to share with you, whether you're seasoned or whether you're new, or maybe you came into the industry right at the pandemic because so many companies were hiring, so many companies were, turning customer service representatives into licensed LOs. And so they went on a huge hiring spree. And maybe all you know is the pandemic market and the pandemic rates. Now, there's an upside and there's a downside to that. The upside obviously was, you didn't necessarily have to understand the fundamentals of actual sales because everyone was lined up around the block, right, to just get whatever you had. And so it was more or less just handing it out. It wasn't actually attracting it, securing it, originating it. It was no brainer, no matter, what experience level you had, just as long as you understood how to, really take down a 1003 or, a loan application and then do pricing. It was just delivering a no-brainer. And so it was very easy to come up at that time. However, some of you watching may have came in a little late. And so you might have experienced a piece of that pandemic, or you might have been a little late to the party. But here's the actual upside. You are joining an industry and your job it's very unique. Like, not many people can sit in an office or, we're in an AC environment, punch some keys and make as much income as we can. But the challenge is though, is that, do you have the tenacity? Do you have the experience? Do you know how to pivot? Do you know how to really, really communicate? And so this video is really going to go over some of the reasons why LOs don't succeed in any market shifts. I should actually add that because you could have survived during the pandemic market with ease, right? All you really needed to really have was, a heartbeat, and you were making well over 5 figures per month. But here's my thoughts on it. The reason why LOs right now are struggling and having a hard time primarily is fear. That's it, fear. A long time ago, I heard this person using fear as an acronym, FEAR. And it was really interesting to me because he said the acronym stood for false evidence appearing real. Now, what does that mean? So that could very well mean that, you see in the news or you see in the media or you see even in your own surroundings that people are like, oh man, rates are up, it's hard, you got to work extra hard now, it's impossible to close loans and no one's refinancing. And so that becomes, evidence, like it's just kind of like your reality, right? But at the end of the day, when you really think about it, what we do as loan originators is we solve problems. We don't sell rate or fees. We don't sell pricing, right? What we do is we understand the true facts. And the true facts are what we're experiencing from a professional point of view in terms of the rates going up, the inflation, cost of living is going up because we're experiencing it as consumers as well, is that this is happening with everyone. So it's not just you and I, it's not just, our job, it's happening to everybody. And so what happens when the cost of living triples? What happens when the cost of fuel and gas and utilities almost double, if not triple? That's right, it hits us in our pocket. And what's happening is the income or salaries that our consumers live by is not keeping up with the cost of living. And so when that typically happens, people leverage debt. So they leverage credit card debt, or they'll pull out installment loans to maybe consolidate debt or give them some cash. And that's typically what consumers do. More so, if these consumers refinance during the pandemic, they're going to try and protect that interest rate beyond anything. But little did they know is that they're taking on debt at a higher interest rate, and they're actually setting themselves up to have a very long-term loan. Because typically with like installment loans, they have such high interest rates that whatever payment is due mostly is interest. Little by little, they'll see the principal actually chip away. But if you really think about it, they're gonna have that payment or additional expense for a very, very, very long time. So anything outside of the mortgage, what I want you to start doing is I want you to start adopting these classifications. So like auto loans, which is basically a loan against a car, obviously, but it's a depreciating value. So the depreciation of that car far outweighs the length of time that a consumer has to pay a car. And so typically what happens is if they get like a 6 year, 7 year, I think the other day I saw one for 8 years, and it was a car loan. And I was like, man, that thing, first off, right when you drove it off the lot, it depreciated value. Now, imagine 2 or 3 years later, that thing is depreciating massively. And so when that consumer comes time for them to get a new car, they typically have negative equity that they then have to carry on to the new financing for the new vehicle. Does that make sense? So we have to understand that. And another form of debt is installment loans, which are very common these days because people are pulling out personal loans or personal lines of credit to consolidate debt, pay off credit cards maybe, or just get cash for bare necessities like repairs on the house or cash flow to, maybe do other things. Whatever the reason is, these installment loans are also a specific kind of debt. And I'll tell you what those two classifications are in just a second. But revolving debt, whether it's a credit card or an equity line of credit, that's one of the, I would say second to the worst because, like an installment loan, they have high interest rates, but a credit card actually compounds interest daily. Not only that, but they're also adjustable and they're per the market. So as the market and the feds raise the interest rates, so do the rates and the payments on those credit cards. It blows your mind, right? So in other words, even if a consumer says, oh yeah, I paid double what's due, that doesn't necessarily matter. I mean, it's a noble cause, but at the end of the day, your interest on that credit card, it compounds daily. So if the payment that you send, even though it's 2 or 3 times more or $100 extra, you're still paying interest again on the balance on top of the interest that you pay per month. Does that make sense? So these credit cards are pretty outrageous. They go, anywhere from like 13 to, upwards of like 20+%. And I know there are some accounts where it's like, yeah, I get 0% off or 12 months or 24 months. People will tell you, yeah, I use the credit cards, but I pay them off monthly. And then we feel defeated because we feel like, oh, okay, they got 12 months to pay this off with no interest. But you have to understand the likelihood of them paying it off. So if they have a $12,000 credit card at 0% interest for 12 months, how much do you think the payment would be? just to pay it off. It'd be $1,000 every single month. How many people do you know have $1,000 of extra cash flow right now in this market? Not many, right? Now, if you look at the flip side, in terms of the person saying, yeah, I put everything on my credit card and I pay it off every single month, they're usually doing that for one of two reasons. Either number one, they really like the points, the cash back, maybe the flyer miles, but that's very rare. Like not many people are traveling right now because the cost of travel and living is really high. A majority of them really do that because they need to offset their income. So in other words, they put everything on a credit card because of the way they get paid. Now that is a red flag because that means that they don't have enough monthly cash flow to actually cover their expenditures. So therefore they put it on the credit card, and then when they get paid, they then have enough money to pay the credit card. So basically they're living usually a month behind, as opposed to having the ability to pay it out of their bank. So they're using the credit card, whereas if something were to occur, like an emergency or a repair, and they added that to the credit card and they used their monthly income to pay towards that credit card, what is the consumer left with? Well, they're left with more of a balance and they're left with nothing in the bank. This is the reality. This is where we need to understand what we are going up against, right? It's the consumer's mindset. But in my opinion, in my experience, I think the reason why LOs are not really winning right now or are having a hard time in sustaining income and sustaining sanity for that reason is fear. And it's really just fear of like objections. Like we kind of pre-qualify it, and we're so used to seeing lower interest rates, or we see the difference in the gap between the rate that we're going to give them versus where they're at now, and we lose momentum, we lose the enthusiasm. And our focus should never be on the rate or the fees. The focus should be on, here's where you're at, here's the old side, right? And here's the new side. And that's what I like to do nowadays, especially in this market, is have our clients somewhat do, they call it a T-chart. And so as I'm pitching my loans now, I have them grab a blank piece of paper, I have them draw a vertical line right down the middle, right? Top left, right old, and then top right, right new. Make sense? So what they're doing is they're gonna list out all of their liabilities right now, and then you give them the total, and then on the right-hand side, the new side, is their new payment, their monthly savings, and their the payment deferral and their escrow balance refund. Now there's a lot of psychology behind this. Number one is when you have them write it down, you expose their awareness of all of these payments that are going out. Number two is visually, as they're writing it out, they are absorbing it not only kinesthetically, not only visually, not only via audio, as you talk to them, but they're actually seeing the picture. Not only that, but that's on the old side. The new side is your presentation. And what does everybody love? Why do people line up at Apple and they buy the newest iPhone, right, months ahead? For you guys who are Android lovers, weird as you are, you understand just the whole concept of people just naturally like things new. They don't like old things. So we're trained to, always want something new or desire something new. And I think that really does help kind of define the overall comparison, because nothing on there has anything to do with rate or fees. It just simply has to do with increasing cash flow, here's the two classifications: removing unhealthy debt and making it to healthy debt. Healthy debt being a mortgage. Healthy debt meaning it's attached to an appreciating asset. As values go up, that's a good asset, right? But it also gives you the leverage to write off the interest. So now you're taking all these negative, unhealthy debts and you're turning it into healthy debt, meaning a lower payment, lower overall average interest rate, right? So if you consider they're at 2.75, what about all these cards? These cards are at 16, 18, personal loans are at 26%, car loans at 9%. When you take all that in consideration, their actual effective rate over all that debt could very well be 13, 14%. Does that make sense? Not only that, but if they tell you,
say, yeah, you know what, I need to think about it. Yeah, it looks good, but I don't know. I don't want to, I don't want to let go of my 2.5% interest rate.
You can always show them and say, fine. All right, so if you don't need this $500 savings, apply it to the new healthy debt, apply it to the mortgage. You'll actually pay this house off in 8 years sooner, right? Instead of 30 years, you'll pay it off in 20 years or 22 years, whatever it is. And interest on a mortgage works a little bit different. Interest on the mortgage is based on the amortization. So if you pay it off in lesser time, your rate actually is lower than what you have. So in other words, if I had a 30-year fix and I was considering like, yeah, you know what, I'm okay, I'm gonna stick on this 30-year fix. I don't need the $800 or the $700 savings that you're showing me. I'm just comfortable where I'm at. The idea here is that if I were to take that $800 savings and apply it to this mortgage, let's say it's at 6%, I would pay it off in about 20 years. That would actually make my effective rate in the twos. Now it makes sense, but not too many people actually put that together. So visually, it's going to help you overcome those objections. Like, oh, the rate's too high. Technically, your effective rate is X. This program is actually chopping your interest rate, your effective rate in half. Or the other is that the fees may be too high. Well, technically, your investment on this is let me break that down for you. And so what you do is you take the total fees or costs, but you never refer to them as cost. You never refer to it as fees. You always want to kind of change their perception and look at it as an investment. So let's just say I'm charging $30,000 in fees, right? That includes points and third-party fees. Well, in the transaction, they could skip technically up to 2 payments, depending if you close, the first week of that month. And so, timing is all of importance here, right? Either way, if it's 1 month or 2 month deferral, you simply take that amount, 30,000, and you minus out the total monthly expenditure. So let's say the mortgage, the car, the credit cards, everything came out to, let's say $3,000. So I'm taking $3,000 out of that 20, now it's 17. But they're also getting a escrow balance refund, and let's just say that's $3,000. And so now I'm taking that $17,000 and I'm deducting $3,000 from that with justification, right? So these funds, right, like your escrow balance refund or your payment deferral, that is by choice. They're already counted in the loan. If they don't want their loan balance going up or they don't want to put it in the bank, they are more than welcome to bring that $6,000 to the table at close. But because every person we're talking to on average has less than $2,000 in the bank, what do you think they're going to choose? But this is a concept where you're actually minimalizing the amount they believe is a cost. And so the reason why we say that is because it's accounting for your deferred payment. It's accounting for your escrow balance because we're establishing a new escrow account. So technically, after the deductions, your net, and I think I said 30,000, I don't know why I said 17, but 30,000. So technically your net investment towards this is only $24,000. So if I broke that down monthly, right? And monthly, basically what you do is you take the 24,000, right? This is after you take out the payment deferral and the escrow balance refund. You take that remaining sum and you divide it by how many months of the term. So let's say a 30-year fix, you divide it by 360 payments, right? So that 24,000 then becomes, I don't know, let's just say $30 a month, for example, right? I'm good at math. I can't do math that well. But let's just say that, that 24,000 comes out to $30 a month. So in other words, sir, your investment comes out to really only $30 per month. In exchange, you'll get $600 in payment savings. So I don't know any investment instrument that's available today where you pay $30 and you get $600 in return. Does that make sense? So that's kind of a way to help in terms of overcoming the fee objection. But another thing is like they look at the mortgage payment. Oh, my mortgage payment is going from this to that. Well, technically, it's not just your mortgage payment, it's all these debts. And because you're barely making the minimum or you're on compounding interest, you're gonna have these debts for a very long time. So if you really think about it, your payment for the foreseeable future is not the $1,100 mortgage payment. It's $3,000 over all of your debts. We're taking that down to $2,400, right? And so that's where the savings come in from. So I know the payment might be going up, but you're technically making this payment right now. If you can afford $3,000, I know for certain you can afford $2,400. It's just your understanding of what is actually real. And it's not just your mortgage. You have other mouths to feed with your one income. You have the car loan, you got the credit cards, you have all of this. And that's the primary reason why your net or your checking and savings stays the same, is because what comes in goes out. But here's the thing. If an emergency occurred or if the cost of living continuously increases, the last thing you want to be in is at a deficit. Because if you're at a deficit, you're going to start actually liquidating your savings or your checking. And then what happens? You're forced to increase the balances on your credit card, which then increases your monthly obligation, which then increases your monthly deficit. Does that make sense to you guys? So, I'm gonna send out some more, content with regards to this matter. So please stay tuned. If this is your first time coming across my channel, please comment below. Let me know what your feedback is. Definitely want to make sure you subscribe. Check out my other channels, share the information with your colleagues and people who also in this industry that is also having a hard time and could find this information valuable. If you've been following and supporting my channel for a long time, I appreciate you. I see you. What really helps me in return is just simply sharing, liking, and commenting. We're playing an algorithm game. I'm giving you information right now to help you sustain this current market shift, help you stay paid, help you feed your family, help you, continue winning. So all I'm asking in return is just show your support by hitting that thumbs up button, making sure that you comment your feedback, good or bad, that's fine, just comment and share it. Share it with some people that, has not heard of this channel, or share it with someone who may have problems with these particular objections because you might already know how to get past it. Share it with your team, share it with your manager, what have you. Either way, I appreciate you taking the time to watch this video. Stay tuned for the next one because I'm gonna cover a ton of content that has to do with right now. The market now as we go into the fourth quarter of 2022, you wanna make sure that you have this information in your arsenal so that you could be market proof. Thanks.